Is the market rotation here to stay? Let's ask the Wharton School Professor of Finance, WisdomTree Chief Economist Jeremy Siegel. Professor Siegel, thank you very much for joining us here. As I've laid out the market action and we kind of allude to what's going to happen next week with the Fed and interest rates, just how much of this market right now is going to be dependent on just a handful of key sectors and then, of course, future interest rate policy?
Yeah, both. I mean, some of the fluctuations have been wild. I think Wednesday was the biggest drop of Mag 7 versus the S&P in 4 years. There's some analysts that say, should we even call it the Magnificent 7 anymore? What moonshot, competition, margin erosion, and on top of that, as you rightly mentioned, next week is very important. What does Kevin Warsh think of this oil increase? 2 weeks ago, we had WTI at 70. Now WTI is at 90. And you were right. There's a lot of hope, but hope springs eternal. And we've seen hopes being dashed in the past. But what does Warsh think of this? I mean, is he willing to look past this or not? And by the way, I would not be surprised to see some hawkish dissents in the meeting on Wednesday.
In years past, Professor, we've heard and maybe heard some kind of, I guess, maybe sarcasm with regard to one word in particular that came out of the Fed and Jay Powell's Fed back in the day, and that was the word transitory. We don't really use it that much anymore these days, but still there's a feeling that the transitory or non-transitory nature of inflation is going to be a huge focus for the Fed, for investors. Is there maybe that hawkish tilt because we don't want to ever view something as transitory in terms of inflationary pressures and then be caught at least blindsided by it?
You're perfectly right. I mean, transitory under Powell, describing the COVID inflation, really became a word, like he said, let's retire that word. So that fear. But there is a good point. I mean, let's hope this war is going to be over. Oil is going to go back down. Oil will be in surplus going back to 60. So this is a much better transitory story, honestly, than anything over COVID, when the government was spending trillions and trillions of dollars and the Fed was, I think recklessly just expanding the money supply. So there is a case that if you take what's called those long-term expectations, the difference between the inflation-protected bonds and the standard bonds, we have not seen anywhere near as much of a widening. Something the Fed calls the five-year, which is looking beyond 5 years, which is cyclical and far out, has not seen any really appreciable increase in inflation expectation. Now, if Warsh wants to keep holding and makes the case for that, I'm sure he's going to bring that up. But there's a lot of people seeing inflation in those core numbers beyond just the energy that I think are going to speak up and say, listen, I think it's time to raise at least 1/4 of a point. So Wednesday is going to be a really important day, in addition to all these earnings, of course, that are coming out every day.
How much do interest rate expectations and what exactly they could do from here factor into whether or not this market, in your mind, is fair valued, overvalued, or undervalued? I want to just, earlier today we had talked on the halftime report about Bank of America's Michael Hartnett issuing a note to clients saying that they do not yet see the level of interest rates as a threat to anything but bonds bull market in risk assets. I mean, that means even at 4.7%, approaching 5%, that it's not an area that we think it's going to derail the growth and earnings thesis around the fundamentals in the market. Does that seem to click with what your research and what your analysis says about the market these days?
Not yet a threat. But, we're getting close. We're getting close to the highs of the interest rates we saw when Powell was stepping on the brakes really hard to stop a much higher inflation 3 and 4 years ago. I like to take a look at what's called the TIPS yield, the inflation adjusted yield. That 10-year is going to 2.5%. Now, when you have a 20 PE stock market, which is pretty much what we have now with these declines, that's a 5% yield real on the market. So there's still a margin there, 2.5%. That's a little bit lower than historically, but it's still an edge that I think is important on stocks versus bonds. So I would agree, not yet a threat, but if we see those real yields continue to rise, there's no question. I mean, that's the other end of the scissors. You know, you have the denominator of interest rates, you have the numerator of earnings, and if those interest rates go up, whatever earnings are, that might not be enough to offset it.